the stock market should have already crashed. That's not a hot take. That's not fear-mongering. That's what the data says. Consumers are drowning in debt. Interest rates are the highest we've seen in decades. Inflation has crushed purchasing power. Layoffs are quietly spreading. Economic growth is slowing. By every historical standard, markets should already be down. And yet, stocks are still going up. Indexes are hovering near all-time highs. Volatility feels strangely calm, and every rally is explained away as resilience. But here's the part that should make you uncomfortable. This is not a sign of strength. It's a warning, because markets don't crash when things look bad. They crash when the forces holding everything together finally break. And right now, those forces are still working, barely. That's what makes this moment dangerous. Most people assume that if a crash hasn't happened yet, it probably won't. They confuse delay with safety. But in financial history, delay has never meant safety. Delay has always meant pressure. Think about it like this. A bridge doesn't collapse when the first crack appears. It collapses when the final support gives way. Markets work the same way. The longer reality is ignored, the more violent the correction becomes when it finally arrives. And what we're seeing right now fits that pattern perfectly. Bad news no longer shocks the market. Recession headlines are ignored. Warning signs feel routine. That numbness isn't confidence. It's complacency. And complacency always comes before collapse. This is why the fact that the market hasn't crashed yet is not reassuring. It's unsettling. Because once you understand why the market is still standing, you also understand how fragile that support really is. And that's exactly what we're going to break down next.
Let's start with the most basic question. If the economy is under stress, if consumers are stretched thin, and if interest rates are this high, why hasn't the market already collapsed? To answer that, we need to look at valuation. One of the simplest and most powerful valuation tools ever created is something Warren Buffett has referenced for decades. It compares the total value of the stock market to the size of the real economy. Market capitalization divided by GDP. Right now, the market value of all publicly traded U.S. companies is roughly $66 trillion. U.S. GDP is about $30 trillion. That gives us a ratio of over 200%. To put that into perspective, anything above 100% is considered overvalued. Before the dot-com crash in 1999, this ratio peaked around 115%. Not 200, not 150, 115. And the market still collapsed by more than 60%. By that measure alone, today's market looks more expensive than almost any moment in history. And it doesn't stop there. Price-to-earnings ratios tell the same story. Historically, the S&P 500 trades around 15 to 16 times earnings. Today, that number sits closer to 25 to 28, already elevated. But the real danger isn't the average. It's what's driving the index. A handful of massive companies now dominate market performance. Nvidia trades at more than 50 times earnings. Amazon sits in the mid-30s. Microsoft is near 40, and Tesla, nearly 300 times earnings. That means investors are paying $30, $40, even $50 for every single dollar these companies earn. This is not normal behavior. And here's the uncomfortable part. Right before the dot-com crash, S&P 500 price-to-earnings ratios were in the exact same range they are today. Different story, same math. Every traditional indicator says the market is overdue for a correction. Yet prices keep rising, which means the indicators aren't wrong. Something else is holding the market up. And that's where the real explanation begins. So if valuations are stretched and fundamentals look weak, why hasn't the market collapsed yet? The answer is simple, but uncomfortable. Because powerful forces are still holding it up. And almost no one talks about them. Force number one is government spending. Officially, stimulus checks ended years ago. But in reality, the government never stopped stimulating demand. It just changed the method. Right now, the U.S. government collects roughly $5 trillion a year in taxes, but it spends closer to $7 trillion. That $2 trillion gap doesn't disappear. It flows into the economy. It flows into companies, into payrolls, into contracts, into consumption. And when consumers keep spending, corporate revenues stay elevated, even when the economy is weakening underneath. This kind of stimulus is quiet. It doesn't show up as a check in your mailbox, but it props up demand and delays the reckoning. However, this comes at a cost. With nearly $38 trillion in national debt and interest expenses now exceeding $1 trillion per year, this approach has a shelf life. The government cannot spend like this forever. Which brings us to force number 2, dollar devaluation and inflation. When more dollars are injected into the system, each individual dollar becomes less valuable. Prices rise. Companies raise prices. Earnings appear to grow. But this is not real growth. It's inflation disguised as success. Wall Street understands this dynamic very well. Rising nominal earnings support higher stock prices even when real economic activity slows. This combination, government spending and a weakening dollar, has kept markets afloat longer than logic would suggest. But these forces don't eliminate risk. They delay it. And delays in markets rarely make crashes smaller. They make them worse.
Now let's address the biggest question. If the warning signs are everywhere, why hasn't the crash already happened? This is where most people misunderstand how markets actually work. Markets do not crash when conditions turn bad. They crash when confidence finally breaks. Think of confidence like a bridge under stress. The bridge doesn't collapse when the first crack appears. It collapses when the final support gives way. Right now, confidence is still holding, but it's being held together by 3 fragile threads. The first thread is consumer spending. The US economy is driven by consumption. Roughly 70% of GDP comes from consumer spending. And right now, consumers are still spending. But they're not spending savings. They're spending debt. Personal savings rates are near historic lows. Credit card balances are at record highs. People are financing everyday life. And that is not sustainable. When consumers finally pull back, corporate earnings will fall, and markets will follow. The second thread is the labor market. On the surface, it still looks strong, but underneath, it's weakening. Hiring has slowed. Layoffs are increasing. Full-time jobs are declining while part-time and multiple job workers are rising. This is a lagging indicator. It always weakens right before a downturn becomes obvious. The third thread is the belief that rate cuts will save everything. In past cycles, they did. This time, they won't. High debt, high costs, and exhausted consumers cannot be fixed by cheaper money alone. These 3 threads are fraying, and once one snaps, the others follow quickly.
Here is the uncomfortable truth. Market crashes never come out of nowhere. They are always preceded by the same psychological sequence. And what should worry you most is that all 3 phases are already happening right now. Phase 1 is denial through strength. Markets stay elevated longer than anyone believes is rational. Prices keep rising even as fundamentals deteriorate. This frustrates investors. People start saying, "This makes no sense." That frustration is not a sign of safety. It is a warning sign, because right before every major crash, markets feel disconnected from reality. Phase 2 is numbness to bad news. It's called crash fatigue. Investors hear negative headlines over and over again. Inflation, layoffs, earnings warnings, debt problems. Eventually, they stop reacting. Bad news no longer moves markets. That silence is extremely dangerous, because markets stop responding right before confidence breaks. Phase 3 is the trigger. It is rarely dramatic at first. A bankruptcy, a credit event, a major company missing earnings. One event breaks the illusion. Selling accelerates. Liquidity disappears. And the crash everyone expected months ago suddenly arrives all at once. That is the pattern, and we are already deep inside it.
So the real question is this. If all the warning signs are flashing red, why hasn't the market already collapsed?
This is where most people misunderstand how markets actually work. Markets do not crash when conditions become bad. They crash when confidence breaks.
Think of confidence like an overloaded bridge. It does not collapse when the first crack appears. It collapses when the final bolt snaps. Right now, confidence is being held together by 3 fragile threads, and all 3 are starting to fray. The first thread is consumer spending. The US economy is driven by consumers. Roughly 70% of GDP comes from consumer spending, but personal savings are near historic lows. Credit card balances are at record highs. People are spending money they do not have. That can continue for a while, but it is not sustainable. When consumers finally pull back, corporate earnings fall, and markets follow. The second thread is the labor market. It has not been strong. It has been delayed. Hiring has slowed. Layoffs are increasing. This no hire, no fire environment is fading, and labor market weakness always shows up late in the cycle, right before downturns. The third thread is the belief that rate cuts will save everything. In past cycles, lower rates created a cushion. This time is different. High debt, high costs, and stressed consumers mean rate cuts will not fix the problem. When these threads finally snap, the market does not drift lower. It breaks.
Here is the part most people never see coming. Market crashes do not arrive out of nowhere. They follow a pattern. And what should concern you is that all three phases of that pattern are already happening right now. Phase 1 is frustration. Markets stay high longer than anyone believes is rational. Bad data keeps coming. Warnings keep piling up. And yet prices refuse to fall. This creates confusion. People stop trusting their own judgment and assume the market must know something they do not. That is exactly where we are today. Phase 2 is numbness. Bad news stops moving markets. Inflation headlines, layoffs, earnings warnings. People hear it all and feel nothing. This is known as crash fatigue. It happens right before major downturns. Because when bad news no longer scares people, it means confidence is already fragile. Phase 3 is the trigger. It is rarely dramatic. Not a world-ending headline. Not a perfect storm. Sometimes it is just one bankruptcy, one credit event, one earnings miss. That single event breaks confidence. Selling accelerates. Liquidity disappears. And the crash everyone expected months earlier finally arrives. That is why crashes feel sudden. People mistake delay for safety. But delay actually makes the collapse worse. The longer a correction is postponed, the faster it happens when it begins. The market has not crashed yet, not because the economy is strong, but because temporary forces are holding it up. And when those forces weaken, prices do not gently adjust. They snap back to reality. This is not about fear. It is about awareness. Understanding this cycle allows you to stay rational when others panic. Protect capital. Avoid leverage. Be patient. Because when the reset comes, opportunity belongs to those who were prepared.